Okay, hi everybody. I'm Steve McGregor. I'm Business Development Director for Tavistock Wealth, and I am delighted to be joined today by our Portfolio Manager for Physical Assets, so that's commodities and property, Jonah Levy. How are you?
Very good, thanks, Steve. Good morning. Happy to be here.
Good man, and you're in the office, I see.
I'm in the office. A nice change of scenery, finally.
Good. Good. It does feel like things are starting to return to some kind of normality, doesn't it?
Yeah.
Spring is here, the kids are at school,
So,
evenings are getting lighter, so yeah, lots of things to look forward to.
absolutely. Yeah, I went for my first run of the season. Horrible, but enjoyed it nonetheless.
It's got to be done. It'll get better from there.
I hope so.
The last time we spoke was towards the end of November, actually, so 4 months ago, after what was a pretty unique and exceptional 2020. Before we go on to how 2021 started, I think it'd be helpful just to summarise what took place in 2020, particularly for your area of specialty, because it's a really fast-moving part of the asset allocation that we've got here. So commodities was on a bit of a tear, wasn't it, in 2020? So yeah, can you just summarise where we were 12 months ago?
Yeah, absolutely. And I think, yeah, as you say, commodities are fast moving. I think what characterized the start when we heard in March 1st, or even before that in February, we saw the start of coronavirus sort of coming to impact both our domestic lives, but also equity markets, commodity markets, etc. And I think what really summed it up initially was in April when oil prices sort of went negative, if only for a day. And I think really that was the big shock. And obviously that was also the bottom for commodities. Demand fell off a cliff. People didn't want to take delivery of oil. And I think that really sums up the feeling that people had about markets at that point. But since then, as you say, yeah, commodities have had an absolute tear over 2020. We'll get on to 2021, but that has continued so far this year. But since then, both broad-based commodities, so baskets of major commodities, but also more niche and more specific commodities have gone from strength to strength in 2020. So looking, I suppose, starting with metals, with precious metals. So gold and silver both had miraculous recoveries in 2020, I think both on the back of fears that COVID would keep getting worse. And so that was why precious metals sort of started outperforming from March onwards. But then obviously through sort of September, October, November, as the global reopening started and vaccine positivity sort of came through in the media and then through into sort of our daily lives, you saw the industrial metals and those metals that would benefit in a reopening sort of coming through. So that's the coppers and that's the iron ores and things like that. And so they've sort of done very well in the second half of the year of 2020, and in the first half of the year, precious metals, which acted as that hedge against sort of bad economic times, performed very well. And then so we managed, I think, in the portfolios to capture that through silver. So that silver, 50% absolute return on silver through 2020. Now that was very good to see. Gold too sort of went from strength to strength. And energy prices, I suppose, after they bottomed out in April, they've gone like the rest of the commodity world, sort of from strength to strength. So they sat at sort of $25, $30 a barrel in April, and they finished the year above $55 a barrel. And that obviously really is a proxy for sentiment around the reopening. So as coronavirus fears sort of faded, people thought, okay, now's time to sort of get back into those reopening trades. And so oil prices really hit that V shape that we saw in equity markets too, but sort of, as you say, much more accentuated and happened much more quickly. I think one of the consequences that we saw coming out of this pandemic in 2020 was the impact that sort of stimulus spending and inflation expectations on the back of that. So central banks around the world pump more money into the system. Commodity prices have to adjust to reflect that. And at the same time, what you saw through 2020 was lots of supply, both in agricultural side of things, but also on sort of the mining and the energy supply side of things. That really fell off a cliff. And that was very slow, I think, to come back. And we're still actually seeing in South America through metals and also through agriculture, we're seeing that supply is still coming back online a little bit more slowly than the pickup in demand we've seen so far in 2020. So I think that for those reasons, commodities continue to outperform. Agricultural commodities specifically, people still need to eat regardless of whether the economy is going well or badly. And so if you look at agriculture, you look at meat prices, you look at the softs, so the corn, the soys, etc., they're all up over 50% in 2020 on absolute terms. So that was one of the areas I think that people saw that whilst supply has fallen off the cliff, demand has stayed pretty constant. It's an absolute necessity. And so we saw massive price appreciation in the agricultural side of the commodity space as well. And then very briefly, I suppose, on property as well. In March and April, people were fearing for their jobs, people were fearing for their livelihoods, and so we saw a massive fall off in mortgage applications. People couldn't build or construct things, and so obviously we saw a fall off in new home starts and commercial mortgage applications. The office space suffered massively. People are still working from home. Thank goodness I'm not today. It's very refreshing. But so the property side of the thing took a real hit in the first half of 2020. And yes, we've seen to some extent at the end of 2020 that sort of picked back up. New home starts, mortgage indexes, things like that really began to pick up, but they're still relatively depressed, I think, relative to long-term levels. And obviously, as a team, we're monitoring those, but we're not quite there. We're not quite ready yet on the property side. So 2020 was kind of crazy.
It was, and your enthusiasm for the area and for your area of specialty is great, because and it really came to its own, as you've just described so eloquently, last year. This year, I mean, you covered so much there. There's quite a lot to pick back up on. I'd like to highlight a couple of things. Gold sold off a little bit, 2021. What are your thoughts around that? Is that the money going towards Bitcoin? Is it the positivity that we've seen for equity markets, so that the hedging aspect of gold sort of taking the shine off it, pardon the pun, a little bit? Just your thoughts on that, but also specifically around property as well, because we've had a number of advisors that have historically allocated to bricks and mortar property funds, and clearly we've got some issues there with suspension of funds and gating. So if you can just touch on those two extremes, I suppose.
Yeah, Steve, you're absolutely right. We've definitely seen sort of a fall off in gold prices over the last few months. Now, I think that that's largely down, as you say, to equity market strength and people preferring other assets in the meantime. But also we've seen an increase in bond yields in the US and elsewhere. And obviously, when you hold gold, you're not returning an income on that. It's a non-yielding asset. And so whilst bond yields stay elevated, people sort of the opportunity cost for holding non-yielding assets definitely increases. However, we believe that the inflation that we've seen through all of this money supply will continue to sort of provide support to gold prices moving forward. And equity market frothiness as well. So with sort of any fears about a third wave in Europe or elsewhere, you want some diversification, some sort of consumption hedge in the portfolio, and therefore we continue to like gold and we continue to hold it. And then on property too, yeah, absolutely. You know, if you look at the UK commercial funds, most of the bricks and mortar funds have experienced suspensions. It became very difficult to sort of accurately assess property. Surveyors couldn't go out and value things. People were working from home, office spaces remained sort of redundant and empty for a long period of time. And so that's sort of one of the reasons why we're still a bit skeptical, I think, to including property exposure in the fund. We're definitely looking, we're always looking, and we have, as you say, seen a start in that sort of recovery of that data. Mortgage starts, home starts, people are returning back to the office, leases will continue to sort of start again, and people will sort of move back to that normal phase of life. But we're not quite there yet on the property side of things, so we're going to continue to sort of just monitor and hold it.
That's good, thank you. So I think certainly in terms of property, you've got two sides of that, of course. You've got your bricks and mortar, you've got your REITs, you've got your property equities. I guess they bring a slightly different level of volatility and level of risk to the portfolio. So no, that's fine. It's a watching mandate, and I think most people would have expected that to be the case. So that's kind of a nice segue into where we're currently positioned. Property, you've answered. Gold, you've answered. We still hold an allocation to that. What at the moment do you like less? What's the current positioning within the portfolio?
Well, I think what we've seen so far in 2021, as we've begun this global reopening, is promise and also enactment already of massive stimulus packages. So you've seen in US the $1.9 trillion stimulus package, and that's now, I think, going to be followed by rumors of a $3 trillion sort of restructuring infrastructure package. Over in China, you've seen lots of domestic support in supporting people going both back to work, but also on the industrial side in factories and production there. And so I think that's definitely the main theme so far of the first few months of 2021. And therefore, what we have to try and do is obviously, how does that work in our portfolios? And so what we really like at the moment is those industrial metals and construction-based commodities. So that's copper, which we continue to hold, which has performed very well, over 20% outperformance, I think, versus our benchmarks. And that obviously does very well as things get built, but also in that longer-term renewable shift towards sustainable living. So that's in electric vehicles and in solar paneling and things like that. So we continue to like copper. We continue to hold our position in Russian equities. Now that's obviously an energy trade. Energy's been performing very well since the start of the year. I mean, it's come off recently in the last week, but oil prices continue to sort of rise. And so we continue to hold our position in Russian equities. Again, that sort of outperformed the benchmark thus far year to date. And then obviously we've taken a more recent exposure into European energy majors. So that's the large European oil companies, but also more than that, these are the companies that really are sort of at the forefront due just purely to their size and their ability to move capital around. They're the companies that will be at the head of this and at the front of this renewable shift as well. So we've seen the massive recovery in oil prices, and we've seen that sort of reflected in the prices of a lot of these US energy majors. So they've been tracking the oil price much more closely, but what we haven't seen is that same recovery in European energy majors. We've seen a big fall off in the correlation between those two sides of the equation, and therefore we believe that European energy majors are cheap and are poised to perform very well as they begin to sort of reopen their assets, their rigs, their mines, etc. And so we've opened a position there. And then I suppose in the income side of things, we've recently engaged in a position in MLPs, which are C Corp and midstream US energy companies that the oil will come out the ground, and then at the end of the day, me and you will consume it. But between then, there's a lot that needs to happen in getting that oil from the ground into our cars or into our homes. And that's through pipelines, that's through refining, that's through exporting and transporting these products. And they offer a very high dividend. So the dividend yield on that product is historically over 9%. It's currently offering more than that, I think 9.5% at the moment. And so that provides a really nice yield pickup in the income fund, a little more energy exposure again, but we like energy at the moment, so that's where we are.
Excellent, that's really interesting, thank you. Sounds almost too good to be true, that kind of yield. So
well, listen, it definitely, it's a more volatile product, and you obviously have to not think just about the income, you've got to think about capital return as well. So it's a position we've got very tight limits on. We have a small position and we're watching it very closely, but we're there at the moment.
Sounds good. Part of the strategic review that we carried out some months ago was to really assess the impact of the decisions that the investment team have made. And it's really pleasing to see that 2/3 of the time you pick a winner rather than a loser. And clearly you're not going to get a winner every time, but that kind of ratio's fantastic. Historically, I've stood in front of advisors and I've said that we've made a 50% gain on a silver position, for example, and then unfortunately had to deliver the message that we've probably got about a 0.5% or 1% allocation in an Acumen portfolio to that asset class. That's changed a bit. We've concentrated the portfolios a little bit more now. So some of these discussions that you're having here, some of these wins, copper, silver, gold, historically, they're more meaningful in the Acumen portfolios now. Don't know whether you want to just expand on that a little bit?
Yeah, absolutely. So as you say, part of that strategic review was to increase our conviction, and in doing that, what we did is reduce the number of positions sort of across the portfolios and assigned a larger allocation to those winners, or to those winners that we hope are winners. And what we've also done is increase the size of the commodity carve-outs off benchmark. So we've always got to be very careful that we're not sort of throwing everything into commodities and therefore sort of we're losing out on the fixed income or the equity side of things. But yes, absolutely, as you say, we've increased our commodity exposure. Something I probably should have mentioned just before is we've taken a position in a roll select broad-based commodity index, and that constitutes a larger position in the portfolios than it ever has before. And so because of that, yes, we've got more exposure to energy, and we can be, through this strategic review, we can be more active with our higher conviction bets. So yeah, you're going to see smaller number of positions, but with a larger position size. So that's good.
Excellent. That's good. That's great. The lights are going out. I don't know whether that means that our time is up. But just to summarise, Jonah, I think there's I'm hearing lots of positivity. I'm hearing lots of things to look forward to this year, both within markets and outside of markets, of course, in our own personal lives. But you also touched on an air of caution there with regard to the frothiness for equity markets at the minute. I don't know if you just want to summarise how you see the next few months going, in a minute or two, just to finish things off.
Yeah, absolutely. Yeah, I think there's definitely concerns about that frothiness. We've seen the beginnings of a rotation from these growth stocks to these value stocks, which tend to do well in that sort of late stage cycle. And yes, there are definitely concerns about that. When you also then look at the extent of this money supply that's been pumped into the global economy, you think, that's a lot. That's going to cause a rising inflation. That's going to hurt equity markets. But I suppose one of the good parts about the commodity part of the real asset part of what we do is that we can offer diversification against this. So that's why we're keeping gold in the portfolios. That's why we've got those broad-based commodity baskets such as that RollG Select Index, because whilst what we do in the portfolios more generally is we try to maintain that barbell exposure. So obviously we're going to pick up those good times, but at the times when markets do sell off, we want to have that protection element, and that's where commodities, I think, also really come into their own as well. And things, for example, like we just talked about, that third wave that may be emerging in Europe, and and the fears that that could obviously then travel further around the globe again. That's going to hurt equity markets if that comes to fruition. And again, we do have that commodity, that precious metal exposure, I think, in the real asset side of things to sort of protect us a bit. So yeah, there are definitely concerns in the market, but those concerns there are ways to still play those concerns and ways to beat the benchmark. So that's what we're
always here. Opportunities. I love it. That's a positive note to end on. Jonah, really appreciate your time. Thank you very much.
Absolutely.
Enjoy being in the office, being out. And I look forward to seeing you in person in the not too distant future.
Couldn't agree more, Steve. Thank you very much for having me.
Jonah, thank you. Take care. All the best.